Hi, everyone. Thanks for joining us. Today, we're speaking with Brett Copper of Copper Storage Management, one of the leading storage management firms for remote management in America. Our topic is the differences between multifamily and self-storage. A lot of us investors have been in multifamily in the past and are considering investing in self-storage. And there's a lot of misconceptions, and we're trying to apply our multifamily lens to self-storage, and it just doesn't work. So we're going to have a quick talk with Brett, who's going to break it down for us and help us better understand some of the differences. Brett, do you want to give yourself a brief introduction before we jump in?
Yeah, of course. As always, thanks for having me. We always love working with you guys and are excited to get that rolling. Yeah, so Brett Copper, we own a few different businesses in self storage, but for this purpose, Copper Storage Management is our management company. We've got almost 200 stores in I think 28 states. So we like saying 30, but we're pretty close. And then that's been around for about 4 years, and so constantly expanding. And excited to bring on clients like you guys.
Thank you. Thank you. We are very excited to work with you. And as we are lining up our investments for our investors, and we can't wait to bring you guys on. So, you know, coming from a multifamily background, years and years of experience in multifamily, and now that I'm getting heavily into self-storage, one of the first things people always say, no tenants, no termites, no toilets. But it's even deeper than that. When you are looking at a good location for a self-storage facility, what are some of the things that you look for?
Yeah. So there's kind of two ways to see it. So we have first would be physical condition of the facility, and this can vary wildly depending on the price per square foot that you're paying, because sometimes you get it so cheap per square foot you could care less that it's all dirt and it's old and 20 years old, because at the end of the day it's just metal walls for the most part and a metal door, so it's really easy to kind of keep maintenance up and those kinds of things. But typically you look at things like roof condition. As our capex we're going to have to put into it, can I get that credited at time of closing? Do I need to pave it? Do I need cameras, gates? You don't. The good part about storage is there's no yes answer to all of that. You can buy a property that has it, doesn't have it, has
Right.
issues, doesn't, as long as the price you're paying, is a good deal for it, doesn't matter. And there's a lot of markets in the U.S., especially those tertiary markets, that don't require fencing or cameras, and so it kind of makes that a nice place where for multifamily you really have to check all those boxes for what people are going to pay for, and you provide a living condition. And so it's nice in storage when we don't even have to provide a bathroom in most places, code wise, so that you don't have to even keep cleaning that, because that's a terrible thing to do that can go wrong. And then as far as value add for sites, there are really a lot of other factors you look at. Some of it's going to be how far below market rates are they? What's their current occupancy? Can we either expand the facility by adding some extra units or a building, or are you buying it during lease up, like some of the projects we've looked at with you guys that have a ton of upside? And then ancillary income's a big piece. Do they have tenant insurance? Are they able to
Right.
offer any other services that add to that monthly cost? And I think last would be, how well are they really running the property? Are their collections really high? Do they do auctions? Do they have a lot of non-paying tenants? They're not collecting those fees and some others. And the more of those boxes you check when you look at a site, obviously the more value it has and the better that site ends up paying off during the time that you're running it.
You know, you touched on something that's really important when you're looking at the differences between multifamily and self-storage. For multifamily, location means one thing, but for self-storage, it means something completely different. I would never live in a lot of the places where self-storage is, in industrial areas where there's nothing around, business parks, on a main highway. Whereas multifamily, whereas self-storage, that's a great location, right?
That's
And
right.
I'm thinking in particular about our Phoenix City deal that is at the intersection of two major highways. So there are some really interesting differences in terms of managing self-storage versus managing multifamily. What are some of the glaring differences that you know or that you can tell us about?
Yeah, so first and foremost, it's much easier upkeep compared to what you're used to with multifamily. I mean, you have to have so many different facets of code to keep enforcement. People are living in those spaces, and so
Right.
you have a sink that goes out to fix, or if your refrigerator stops running. I mean, there's a million
Yeah.
appliances, a million things that go wrong in there because people are actually living in the space. Where for storage, most cases in the US, we probably don't even have lighting in the units, unless it's maybe over
Right.
10 by 15, 10 by 20. And then that's in some cases. Otherwise, it really is just your roll up door, and walls can get beat up, they can get hurt, and it doesn't matter as long as they're still standing. So your upkeep is so much less substantial. And I think there's a lot less risk as well. You buy a unit that maybe has 10 units for people to live in, and you lose two tenants, you've lost 20% of your income. But in storage,
Right.
you're looking at hundreds of units at a time. And so even if market's down and you end up losing, a good bit of tenants, or you have turnover during this time of year, it's such a small portion of your income. It's why people end up loving it. I mean, it's also unique that in livable space, everything is so comp based, and so it's very difficult to get away from rates. So if people are charging the same thing for the same livable space down the road, you
Right.
really have to charge that. In storage, we are surrounded by not as maybe sophisticated operators, where you go into a market like a Phoenix City, but you've got people that have been there 30 years, they've never raised rates, and they are 50% below market, but they're 100% full. We don't really compete with those. And so you then look at an operator in that same town like U-Haul, where their rates are twice what a lot of competitors are. Well,
Right.
U-Haul's not charging that because they can't get those rates, or because that they don't have issue renting those units. And it just shows you that if you have good marketing, you have a good facility, people answering the phones, you don't have to stay at comp rates if it's not a comparable asset that you're competing with. In a multifamily, that's very opposite. I mean, you are stuck to what the market charges there. Where I think here you have a lot more leadway to provide a better service, better marketing, and demand some higher rates.
You touch on marketing and attracting customers in multifamily. One of the things historically that you did was like direct marketing, or making sure you're top of mind, or throwing events to make sure that the local community
Mhm.
remembers that you're there. How do you, for self-storage, how do you go about leasing up and getting those customers?
Yeah, so everything in storage is about online game, because at the end of the day, storage is a I need it today type of commodity. And so,
Immediately.
someone's getting a divorce, they're going to college. Someone is, kids are leaving for the very first time, kids are coming back home from college. I mean,
Right.
it's always stressful. I mean, always stressful. And so the vast majority of people need a storage unit within the next 2 weeks. I think it's about 90%. And so they
Wow.
go straight to Google. They look at right now, about 87% of people are choosing based on price as the number one choice. And that doesn't mean overall rate as well. That could be things like promotions. So first month free, 3 months, 50% off, any of those kinds of things. But
Mhm.
they're finding us via the internet, whether that's Google My Business, Facebook, paid search results. In some markets, social media, even though that's not as big typically with storage. And so it's very important that you have good online marketing. We've tested over the last few years thousands and thousands of dollars for various owners that want to do direct marketing. And we found that typically the return was about $800 per customer. Well, that's way too
That's
much money.
you can't make money at an
Correct.
$800 customer acquisition cost. That's impossible. Nobody's numbers are going to work with that.
That's
That's
right, and
yeah.
we tried different national vendors, we tried really good ones that have worked for clients on the multifamily side, and we just found that for storage, it does not pay off, and so you don't wanna waste your money on that direct marketing. We also have now about 76% of people are renting from the first 2 facilities they call, which is a
Well,
very, very high number, and so
yes.
answering the phone, having a call center is essential as well to filling up those facilities.
And now that you mentioned that, something that crosses my mind for multifamily, it's very important that I see the unit, the apartment before I rent it. For self-storage, I mean, I just need to, I need a visual, and to make sure that my stuff is going to fit. But I don't necessarily need to, see that unit, and did they make the improvements that they said they were going to make. It definitely is a little bit of a different game. And along that line, talking about improvements for the Phoenix City property we're buying, this is not an issue, but on our next investment, or on future investments, I'm sure it will be. You guys are involved in construction of new facilities or conversion of facilities. How much easier is it to and faster is it to do a conversion of, let's say, a retail box into climate control self-storage versus doing a remodel of a 100-unit apartment building?
Oh my gosh, yeah. So, assuming that you've got a decent box, you don't have to re-roof it or do a new foundation. In
Right,
most cases, conversions are 3 months to 6 months tops, and I mean that's to churn out a very large space. You could take a retail box of maybe 40, 50, 60,000 square feet and have that completely built out in 5, 6 months, which is a very short amount of time turnaround. And so, it's very popular in storage. I think the interesting part is if you are targeting those boxes that are maybe 50,000 and below, if you could get between 30 and 50,000, because forever, all the bigger boxes have been bought and converted in storage. Every time a Kmart closes down, Winn-Dixie,
right.
Walmart, whatever, people jump
Really,
into it.
really
But it's
fast.
private equity groups doing it. And so they use the traditional REIT management for those big ones. So they can't make the small ones work. So we have this oversupply now of all of these smaller boxes that you can get a similar NOI using this model to
Mhm.
the larger boxes with the traditional model. And so it kind of gives you, your investors, this huge runway to try and find those spaces that are going to be coming to market because people just aren't using them anymore. Now you've got a good method where you can make really good money going after those type conversion deals.
Well, I'm glad you mentioned that because that definitely is something that is always top of mind for us. And as we're looking at our next deal, our next deal, our next deal, we're doing that math. Let's wrap up with a quick discussion of when you have a facility and like our Phoenix City, and we need to lease it up, what is the risk factors? How is self-storage potentially less risky than a multifamily, that if you were buying that at, say, 30% occupancy, how is self-storage less risky than multifamily?
Yeah, so typically with storage, the best indicator is not going to be square foot per capita. People like to throw that number around, but for our consulting firm, we've had sites that were 70 square feet per capita that made sense to build more storage because everywhere was 100% full with
Right,
really high rates. And then there's been places with zero point 0.7 square feet per capita that make no sense to add storage. And so that number gets used, but it's really not important. What you look at are the current market conditions. And so you look at how many people are currently renting, the facilities within 3 miles, which I would say Phoenix City is a good 3 mile market. You're not really going to go further than that based on where that location is.
right,
And everywhere's full. And then you've got places that are more sophisticated that are operating at such higher rates. And so that confidence to come in where the need is very easy to see, it's easily quantifiable when you have existing facilities, existing demand. And then in our mind, we've also owned and sold facilities in Phoenix City, Alabama. So we know that market really well. So that's a good advantage. But overall, we've always felt that it's easier for us to predict self-storage need than livable need. And granted, for people that live in that other world for multifamily, maybe that is easier for them, but
right,
it's so easy to see that need. And especially a site like that where you don't have really much climate control in the area at all. It's underserved for climate controlled, and the existing climate has such high occupancy, has such high rates. It's an easy answer of, yeah, there's really no risk here. I mean, as small as the gain is, it's not like you're adding another 60,000 square feet multi-story climate controlled. So it makes it
right.
easy when you can find that size deal for that amount of money instead of having to invest $5-10 million on worth of multifamily apartments. It's a lot less risk.
Okay, I know I said that was going to be my last question, but as you were
Yeah.
speaking, I came up with one more. You guys have extensive experience. I mean, everyone out there, don't let the baby face fool you. This man has decades of experience because he was born into the business. So you've seen multiple market cycles, but even with our COVID cycle that we just came through, and there's some talk of us potentially going into a recession. What happens with occupancies in self-storage in a bad economy?
Yeah. So we think we've seen now probably about the lowest occupancy is going to go. I mean, typically during the winter, it might go down another 2 or 3%, but historically we were sitting at about 90 to 93% up until about maybe 6, 8 months ago. And so now the floor is probably about 83% or so. Some operators, depending on the market, are at maybe 80%, some are at 85%. But overall, it's a very small drop when you're talking about at max 10% to what we're used to.
Right.
What's funny is if you look historically pre-COVID, we're about the same, honestly, as the cycle. It's really not much lower at all. But COVID was so monumental. I mean, we had properties we sold at returns of in 2 years of 180% average across 20 sites. I
Wow.
mean, ridiculous. So we're not going to see those numbers probably right now, which is a good thing because it overinflated too many sites. But what we're seeing is um, we're buying again. So we're starting to put a bunch of sites under contract where we really haven't over the last 6 months because the costs are coming down on properties, which means we're finding value again. But most of us in the business think we've hit the floor occupancy wise. And then come March, we're going to see that nice swing back up like we're used to seeing, and we'll see occupancies climb. But if the worst it gets is 83%, that's pretty solid as an asset class compared
It's
to
not
a
bad,
lot of other real estate classes.
especially compared to multifamily. Well, we appreciate that you guys are taking our Phoenix City asset on for management, because we understand that you guys look at a lot of potential projects to manage, and you don't accept all of them.
Right.
Your acceptance rate seems to be less than half of the deals that you underwrite and you take a look at. And I'm just throwing that number out, but I mean, that's just
No,
kind of,
that's accurate.
oh, okay, well,
Yeah.
so we feel like, we have a very solid asset, and we're very excited, not only for this deal, but also for future deals. Brett, can't thank you enough for taking the time to have this conversation with us. Look forward to working with you and many more conversations in the future, and also introducing you to many of our investors as we educate everybody about how incredible self-storage is. So thank you very much.
Thanks, Christy.